All right. Welcome to the first episode of season 3 of Millennial Money Matters with Kelly Turner.
And Derek Mazzarella.
And we are in a new podcast studio.
New studio. Look at us moving on up in the world.
We are fancy. We are not in a dark blue room anymore.
Yeah, we've a couch and a nice chair.
Yeah. So
and some accoutrement here.
right. So
Yeah.
so new year, new us.
New us. Yeah.
New us.
New bills
New
to talk
bills.
about.
So we are coming in hot today. We were thinking of what to talk about, and Derek told me that we had to talk about this.
Well, it's so big.
And
Beautiful.
So what are we talking about today, Derek?
We're talking about the one big, beautiful bill.
The OBB, you
Yep.
know me.
Yep. This 1,000-page tax bill.
Yeah, I had to do a lot of Googling.
Well, luckily for you, I've been in the basement eating coffee grounds and chugging Mountain Dew, trying to get ready for this. So I'm ready to roll.
Okay, I'm glad that one of us did. I went into ChatGPT and asked it a lot of questions, and it was confused as well.
All right. Why don't we start with what were your questions? Where do you think we should start?
Okay, why did we pass the big beautiful bill? What? And I know this could be like a 6-hour long episode.
Yeah, we're
if
gonna
we went
keep
through
it
all
a half an hour if we can.
Yeah.
And the real big reason was there is the Tax Cuts and Jobs Act during Trump's first presidency, which was set to expire. Right. So we kind of had a ticking clock on a lot of these things. And if it didn't expire, a couple of big provisions in there, like the standard deduction, which everyone has been enjoying, where you just get to deduct a good amount of money from your taxes without having to itemize anything. It's very clean and easy. That would be cut in half. The tax brackets would kind of go reset. So basically the higher end of the tax bracket would go up to 37.5% again, or 39%. And a few other things, provisions like that would fall away. So they kind of had this clock where like, oh, it's not a Democratic problem anymore. It's actually my problem again. So I've got to take care of this bill.
I gotta figure this out.
Yeah, what are we gonna do here? Yeah, so that was the kind of the genesis of the bill. And every president usually has their kind of big mandate, like big thing they want to get accomplished. Some people it's been healthcare, some people it's been taxes.
This one is all encompassing of everything.
Yeah, it's there's healthcare in here and there's taxes in here.
There's like a little bit of it. That was so as I was doing my research, I was not eating coffee grounds and drinking Mountain Dew.
Okay.
I was sitting at my desk drinking my Starbies. It was interesting because you can see all my notes here, guys. There's a lot of notes. It does encompass a lot of stuff.
Yeah, farming stuff's in there, taxes are in there.
Yeah. Now, what
Medicaid.
it doesn't really encompass is me in the housing industry. There's not a lot for us in it. So we didn't get housing, despite the challenges in the housing market, didn't really get a lot of relief through this bill. That's not where this bill was aimed.
No, not really. It was mainly at, I'd say the big agenda item here was let's keep the original tax cuts status quo. I think that was kind of like the big overarching, all right, what are we really doing with the bill? We want to just keep that as is.
So taxes should look more similar to how they have. It's not like a big... You're not really helping. It's not really changing things. It's just keeping them the same.
For the most part, yeah. If you have one big takeaway, it's that for most things, the taxes are just going to be a continuation of the tax cuts.
All right. Well, that doesn't sound so bad.
No, it's not bad at all.
That makes me...
No, I mean, your taxes aren't going up, which is nice.
I'll take that. I'll take that. So, all right. So we have a continuation of some stuff that had happened a few years ago, but then there's also some additions to this. There's some new things.
Yeah. Some of the things that are staying the same, basically, let's just quickly go through that. The tax brackets, those are going to be the same. Those aren't changing. The standard deduction is actually going to go up a little bit.
So that's better.
That's better. Yep. So you have more money. Basically, what the deduction is the higher the deduction, the more money you can deduct off your taxes. And a deduction doesn't mean, hey, if I deduct $5,000, my income is down $5,000. Well, no, actually, it doesn't mean you're saving $5,000 with taxes. It means your income goes down by $5,000. So if you make $100,000, your deduction's $5,000. The government looks like you make $95,000.
Yeah.
So I hope that was clear.
That was clear.
Even though it took a while to get there.
We're out of practice.
I know,
right
yeah,
now, Derek. We're out of practice. We haven't recorded in 2 months, and it's the summer, guys. You're going to be listening to this in September, but we are recording this in August.
Yeah, I know. I've got vacation this week coming up, so
yeah, it's like vacay time.
Yep. So yeah, that's the kind of the main real change, and I think it's probably important to get into all right. What's the tax brackets versus effective tax rate, because that's kind of important to go through a little bit here.
Can we just have a quick point of clarification? So people always talk about tax brackets, and I think even as a taxpayer, paying adult. Like I know that like richer people are in higher tax brackets. But like, could you just give me like a quick synopsis on like, what does that mean?
Yeah, so every dollar you make of income, you're actually not taxed at the same percentage. So it's a tiered system. So your first, 20,000, 50,000 is taxed at one rate, then the next bracket is taxed at another rate. So you're kind of taxed along the way over time. But if let's say you're in the 24% bracket, any dollar you make after that in that band is taxed at 24%. Well, your effective tax rate may actually be something like 13 or 14 is what you actually pay on your like total sum of earnings. So it takes into account what you're taking for deductions. Do you have any tax credits? What are you making? What are you reading in each band? So it's really not like, oh, hey, my bonuses are taxed more. Like, no, that's not how it works. All the income is kind of pooled into one, and it's kind of sifted through each of these brackets.
And are brackets something that you're paying tax? Like, is that from the taxes getting taken out of your pay stub weekly, or is that like the taxes that you're paying at the end of the year, or is it a combination of both of those?
It's a combination of both. You want to kind of align your deductions that you're getting throughout the year with your tax bracket, or kind of figure out actually really what your effective tax rate is. Because if your effective tax rate is like I'm at a 15% effective rate, that means 15% of all your taxes is basically 15% of your income is what you're going to pay in taxes. So that's what you should plan for.
All right, fair. So we've started to dabble in this, but like, how does this bill impact individuals? There's a lot of stuff in there, but like as an individual person, that's what I care about. I'm a millennial, right? And I care about me.
Care about me. What's in it for me,
I care
right?
about me, and I want to know, how does this impact individuals?
Okay, so tax brackets are staying as is. That's one. Standard deduction is going up. So basically, the single rate was $13,850 you could deduct this year. It's all the stuff. Most of the stuff is actually retroactive to 2025, so you'll be able to do this year. The rate is going up to $15,750 for in a single person. Married, filing jointly, it's up to $31,500. So you get to deduct $31,500 if you're married from your taxes right off the rip without having to do anything.
That's nice.
Yeah. They have a new wrinkle. So this is one of the new things. So this is temporary, but if you're a senior, if you're over 65 years old, you can deduct up to $6,000 additional.
Just for fun.
Yeah. Well, he kind of, there was that promise of, hey, we're not going to tax Social Security. And they kind of worded in their letter like, hey, you're not going to pay tax on Social Security. It's like, no, hold on. You get a $6,000 deduction.
Of your Social Security.
Well, all of your income. So if you don't make any Social Security and you're 65, you're not collecting yet, you can still deduct $6,000. But you have to make between $75,000 and $150,000 because then it starts to phase out at certain levels. So you got to talk to an accountant about it. But basically, it doesn't mean everyone gets to deduct $6,000. So if you're making $2 million, you're phased out.
Yeah, you don't get that.
But if you're making under $75,000, you can deduct the entire thing, entire $6,000.
That's okay. So
yeah,
positive, great.
Positive, but it's also temporary. It's only going to be around for a few years, so it's just a short-term thing. And that's you'll kind of see that the episode. There's a lot of short-term stuff that's going to feel really nice for a little bit, but then it's going to go away.
Okay,
yeah.
All right.
Yeah. The other thing is for us with kids. So think about for me, the child tax credit goes up from $2,000 to $2,200. So bank that extra $200.
For me, that's $600 because I got 3 kids.
Yep.
Right.
Per child. Yeah,
per
child.
child.
So that's basically 1 month of karate. You get extra.
Yeah, there you go. I'll take it.
Yep. So some of the new write-offs. So this is kind of like what are they campaigning on? What is actually happening? The no tax on tips.
Yeah, that was a big one.
Big one. I don't understand that personally. It's like, why is a tip dollar earnings not as taxable as my income or your income or someone doing something else?
I don't really know either, because if you were to ask me about income, I think it's probably twofold, but in my opinion, I would relate tips to commission.
Yeah.
Right? It's the same thing. I'm taxed on my commission, a tipped employee. Now, I had this argument with somebody who worked in the service industry, and they said, well, we don't really get paid hourly. And I was like, neither do I. I just make the commission. So I do think that's a little bit confusing. I don't know if I don't really know what the genesis of it is, but the people in the service industry, which I would be excited if you told me my commission wasn't.
Yeah, I'd be real pumped. Yeah. You could just tip me on. Maybe I'll get client tips.
Right.
That way, right?
Tips
get around it
instead of commission.
Yeah. It's just a tip.
Just give me a little. Okay.
No, but I think they have language in there that says like, hey, if it's outside of your normal, if you normally get tipped, then yeah, it's going to continue. So there's no scamming like that. Like, my barber, I'm not going to pay $1 for the haircut and then $30 in a tip.
So, did that happen?
It did happen. It's temporary. You can deduct up to $25,000. But if you're single and you make more than $150,000, it starts to get phased out.
Okay.
So it's just generally for the lower middle income folks
Okay.
do. So, well, I also don't think millionaires are getting tips.
Probably not.
Probably not.
Probably not.
We'll find out. The overtime thing is happening too. So up to 12,500 of mandatory overtime.
So your employer is going to have to section out if it's mandatory overtime or voluntary overtime.
Correct.
And that again, like that is a layer of work for your employer too. And it's also, what are they going to say to you? Like, this is not mandatory or this is mandatory. Like, sometimes you just have overtime and part of the deal.
Once again, don't know the mechanics of that one. You do get a car loan interest deduction up to $10,000.
Oh, hey.
Not too shabby, but if you make more than $100,000, it's phased out.
All right.
Yep. You do the qualified business income. So this is probably something you and I can benefit from. That's actually going to be permanent, right?
All right.
It's phased in now, and basically you get to do 20% deduction for your business earnings income. So if you own a small business or you get things passed through your income, so you're basically not a C corp, you're going to get a nice 20% deduction.
All right. That's nice.
That's a win. Yeah, they were talking about that going away, so that's not too bad.
What is the SALT deduction? Because you knew
state and local income taxes. This was like the one thing that really held up mostly the Republican side.
Did you see my face that I made for you?
What was that about?
Well, first off, all of the names on this bill are ridiculous. That we've got, like, again, I'm not gonna. Can I say this in the podcast?
Say whatever you want.
Right? Is when I saw like the OBB, all I thought about was what was that musician in the 90s?
You down with OPP or whatever?
Yes. Yeah. And then you got like the SALT deduct. Like, it's got a lot of like ridiculous acronyms, which like is the government in general. The government loves ridiculous acronyms.
Yeah.
But when I saw the SALT deduction, I was like, you can see me in my note. I had to Google what that was. I was like, I don't even know what that is. But people are excited or into that. That's like a big one with a lot of discussion around it.
Yeah. Well, that's where certain states really push that, like New Jersey, New York, California, because they have higher state taxes.
Okay.
Right. So that goes to your state and local taxes. So your homeowner's tax, your property taxes, vehicle taxes, all that stuff can be included in here. So previously it was $10,000 was the cap. So basically the standard deduction was well above that. So most people weren't even taking deductions for their house at all. And they used to, if they itemized before, that was kind of a nice win for them. And about 42% of households actually have more than $10,000 in that SALT tax area. This is pushing up to $40,000, and it doesn't matter if you're single or you're married filing jointly. You get $40,000 to deduct there on state and local taxes.
Okay, so that's a win for a lot of people.
Yeah, I mean, basically, only about 1.6% of the population has more than $40,000. And you know what this does cover, which may help you a little bit, is vacation homes. So you got a vacation home, you can add both of them up together, put your hands together, and now you get some SALT deductions. Now, this is only temporary, though, the SALT deduction. Oh, yeah, of course it is. Yeah.
So 2029, we got to revisit this again.
Also, if you have rental properties, I get a lot of questions like that. Does not count. But if it's like, hey, I have a vacation home, I go there half the year, let's say, I can use half the property tax to deduct. So it's personal use basis.
Okay. So you got to say, I use this personally a lot.
Yeah. So if you have 17 multifamily properties, like, you're out of luck. You're not getting that deduction.
But it's like you got the beach house and you go a weekend and you rent it out a weekend and you go a weekend and you rent it out a weekend.
Yeah. Yeah. And this is you have to itemize to get it. So you can't get the standard deduction plus this. So right now, if you're married filing jointly, the standard deduction is $31,500. It'll give you an extra $8,500 to deduct plus any other. Let's say you got the car loan now you got the other stuff. So you can stack deductions a little easier now with this bill.
If you know how to do your taxes.
Yeah. Or hire someone that does know how to do the taxes, which I would recommend that.
Especially now.
Yeah.
Because this stuff is more complicated. The free turbo tax may not be doing it anymore.
Yeah, and this is where it's probably going to make more sense or be more valuable to hire someone, I would say, because there are a little more nuances. At least this first year, maybe figure it out. Like, okay, what can I get for deductions? What don't I get? Because, you get some of those other funky ones. There's like $1,000 charitable giving one you get now. Not bad. So actually, you get that if you itemize or don't itemize. So it's kind of nice. So you don't have to do that. So that should help charities a little bit, which is nice.
But many of these do not last forever. And I think that's like a piece that we just have to be clear about for people, that you're going to get changes. They may feel good temporarily. And I think like even when we say things do last forever, nothing lasts forever in the government.
Yeah,
like,
this is government permanence, right?
Yeah.
Like air quotes, big time.
And there's no actual permanent. Like we've had permanent things that have been removed in the last couple of years. Like there's not
Yeah, next set of
real.
Congress can come in 2 years from now and just totally say, no, we're doing all this bill away, or we're going to change this, or we're going to raise taxes. I mean, they could do whatever they want.
Whatever they want.
Yeah.
What about these Trump accounts?
Trump accounts. Okay, so babies are going to get, once again, temporary
For a little bit.
$1,000 when they're born, and then you can put in up to $5,000 a year into the account. You do not get a deduction for putting in there, like your 401k or whatever. So your employer can actually match it too, but it still goes into the $5,000 cap. So if your employer puts in $2,000, you're capped at $3,000.
And like, what kind of account is this? Is this a 529? Is it?
No, it's kind of like an IRA, but for kids, because it grows tax deferred. You don't get the tax deduction up front, and then you can't take it out until they're 18. But you can use it for up to $10,000 for a first-time home. You could use it for college expenses and pay no taxes on the money that comes out. So it's kind of like a hybrid 529 thing, or it's kind of like a little bit of an alternative if the kids don't go to college. It's not really designed just for college. So that's a little bit of a nice feature. But overall, there's not like a huge tax savings for the adult or the parent or grandparent to put money in here. So it's just kind of another avenue, because you have things like 529s. You also have UTMA accounts that are fairly tax efficient that can be used for other things. So it's another tool in the toolbox, basically.
Okay, but this is like a new type of account.
Yeah, but it's going to phase out once again. The $1,000 is going to phase out that
So
they're
like,
giving.
some people are gonna get it.
Yeah, so if you're going to have a baby, like, get it on now.
All right, well, it's not gonna help me.
No, not really. Not as much.
Not gonna help me.
Yeah.
All right. How are businesses impacted? Because we've talked a lot about individuals now, right? So
Yeah.
individuals do have some benefits, but there is a lot of I want to say this is the more controversial parts of the bill, that there are a lot of business implications, some to small businesses, but also a lot to larger businesses.
Yeah, I mean, writ large is really going to help business in general, but the big one is the qualified business deduction that almost most small businesses are going to get, which is nice. But then a lot of them it's just kind of more nuanced stuff, like accelerated depreciation, right? So you used to be able to say, hey, I bought this big tractor, right, for my business, cost $200,000. You used to have to deduct it over time. You can deduct all of that now in 1 year.
Oh, okay.
So there's a lot of things like that in the bill that are going to help these larger businesses or even smaller businesses, put money in right away and deduct it this year versus having to wait and do it over time.
Now, I think some of the chatter about this bill is that then it's like the Jeff Bezos, Elon Musk bill, right? That like it's to help those huge businesses, but it appears to me that that's not all the case.
No, not all. But I mean, if you really look at like who it's impacting the most, though, I mean, the things that were set to expire were the higher tax brackets. Like those were set to go up. Those are staying flat now. So that's benefiting the top 1 or 5%, depending on where you're looking at the calculations. So a lot of this stuff is designed to help the higher end of the spectrum. Like I mentioned, the SALT tax, like 1.6% of the population has $40,000 of interest and stuff like that they're paying. So a lot of this is going to be geared towards them, but there are definitely some things that will help out the lower income folks. However, it does seem like those are pretty much temporary.
Those are all the temporary ones.
Yeah,
All
yeah,
right.
for the most part. So that's the one big challenge with this bill is there's a lot to parse through. I'm sure there's some tax nerd that's gone through it more than I have. That's going to say, hey, like we could use this, and this for businesses to really cut down on taxes.
Now, what would you say? I did a little research on, as we came into this about like, there are obviously some positives.
Yeah.
There's also some negatives that people are less into. And the biggest one is it is going to add, ready for this number, guys, $3.4 trillion to the national debt.
Yeah, there's a lot of rhetoric out there says the tax cuts pay for themselves. That does not happen. That's not how that works. There were some stats that came out last year. I think they analyzed the first tax bill. About 18% of it paid for itself. So you might expect something like that to happen again because the thought process is, hey, there's less taxes. I'm going to spend more money, blah, blah, blah. Then there's more sales tax, more revenue. Cycle goes on and on. It's not enough to cover the amount of
3.4 trillion.
Yeah, it's just too much. Like I think even I was looking at the tips thing is going to cost like $300+ million of revenue per year.
Yeah, because and people don't always get that's like the flip side to these things is okay, you're not going to tax tips, but that money went to the government.
Right. And I think that you have to look at kind of what are some potential unintended consequences because any bill, I don't care like where you are, is going to have these unintended consequences. And then maybe, we've kind of seen a little bit with the rating agencies with the government debt. You may see like, hey, we're getting more income, more debt coming out. So we're probably going to have a worse credit rating. And that could potentially impact long-term credit, which is what mortgages are based on.
Correct. Yeah. And that seems to be, some of the rhetoric around housing with this bill is there was some proposals to have more housing stuff in the bill that just didn't really parse out, which is how these bills kind of work.
Right.
People all try to stuff what they want in there. Some of it they get, some of it they don't. But housing was a little bit overlooked in this bill.
Yep.
So we didn't really have a lot of direct impact other than for current homeowners that, again, may have some interest deductions and things like that. But there was not necessarily things to incentivize homeownership. As a matter of fact, there was actually some removals of some housing assistance that was in place prior that has been removed. We don't really necessarily know how that's all going to play out yet. What are the worries for housing? One of the worries is that some of this may increase inflation. So we've been working very hard over the last few years to slowly but surely knock inflation down, because inflation is directly, or not directly, but it ends up directly tied to interest rates.
Right.
The higher inflation is, the higher interest rates are. And so we finally are feeling like a little bit of relief in interest rates. And I say that rates are in the sixes now.
Yeah.
We crossed 8 for a little while.
Yeah. Well, I mean, sixes were kind of historically like 30-year average, right?
We like 5s. So mid fives,
Okay.
mid 5s are generally like, as far as housing is concerned, sort of the marker for like a very stable economy.
Yep.
5s are really where we want to be. So we're still a little bit higher than that, but we're getting closer.
Yep.
And there has been some great programs for first-time homebuyers. There's a lot of these new state bond programs. Connecticut has one. We've talked about the Time to Own program. Mass has Mass Dreams. Rhode Island has Rhode Island Housing. So these have been kind of great. There was no new additions to this stuff in this bill, but the concern with inflation going up is that rates will go back up again. And, we are in a housing affordability crisis. And so, yes, we do want some tax savings so people have a little bit more money in their pocket. Is it going to be enough to make homeownership affordable? Probably not.
Probably not.
Probably not.
Probably not.
It's probably not. So, I think in the housing side, we wish that we got a little bit more.
Yeah, I mean, that's something you might want to see, like, hey, let's maybe get some tax credits for home builders, or hey, like, we're gonna build affordable units, or even attainable housing, multifamily, some kind of thing like that to spur more growth of housing. Because the big problem right now is inventory.
100%.
Yeah.
And not only inventory, but and I tell people this all the time in a town like we live in, is that, 30 or 40 years ago, developments were going in. That was the big developing time. And a lot of these developments were small capes. They were small ranches.
Yeah.
They were maybe small colonials. They were first-time homebuyer houses. When is the last time you saw a brand new development go in that was not either a condo or really luxury housing?
Everything's luxury. The word's lost on meaning anymore with housing.
Yeah. And that's, I had this conversation with somebody the other day about what is a mansion? What is the definition of a mansion? When we were kids, you can like conjure up in your head when you were a kid in the 90s what a mansion looked like.
Yeah, there's like the 2 houses in the town. You're like, that's
you're like,
mansion.
that is a mansion. Yeah. I don't even know what that is anymore. I don't know. It's a 4-bedroom colonial in Glastonbury's a mansion now.
Yeah.
So, I think that housing affordability with these smaller developments is going away. And I think one of the really unfortunate unintended consequences of this economy that we're in is people who were living in that more affordable housing are renovating their houses and making them less affordable. So we see that a lot in our town and other surrounding towns where like you had the $350,000 cape that was affordable. The person now feels like they can't move who owns it. They've now dumped $100,000 into it. They've put an addition on, they've redone the kitchen, and now it's a $400,000, $500,000, $600,000 house. And it's taken out of the affordable housing supply. So this isn't necessarily going to help that.
No, it's not addressing that at all. And the other things kind of maybe pivotal a little bit is the EV tax credits are going away. They're putting a lot more pressure on Medicaid because they have to pay for the bill somehow. They can't just kind of carte blanche do everything. So people are losing a lot of the EV tax credits. So for cars, even just doing renovations on your house, that's kind of a big thing for a lot of folks. Is like, hey, I want to get a new washer dryer or get new energy efficient windows. They're going to be hurt by that stuff.
Yeah, solar. There was some great tax,
solar credits.
Yeah, for solar, that's going away. Yeah, the EV tax credit was a big one. I drive a hybrid minivan. For those of you who don't know, I drive a rockin' minivan.
There's flames on the side of it. I've seen it.
It's so cool. It's got TV screens. It's like a rolling living room. But we were not originally in the market for an EV. We only got it because when we were buying it, we did the math, and the EV tax credits made it cheaper than a regular one. You're like, okay, so I can get better mileage and get these bomb tax credits. Cool. But now my car's 7 years old now, almost 8 years old in November. What is my incentive to buy an EV next time?
It's not going to be there.
It's not going to be there. And are we going to see that kind of going forward?
Yeah, so I think that could potentially hurt that industry in a big way, especially with that's one of the largest job creators is the EV industry. So we'll see.
We'll see. So the one big beautiful bill is interesting.
It's interesting. There's a lot there. It's big, as the name says. It's
big.
actually apt for that part of it. Yeah, I think this is just there's a lot in here. And I don't expect you guys to just listen to this podcast being an expert. I'm still not an expert. I'm working through it. I mean, he announced it on July 4th. Like, thank God. Yeah, great. So I have no time to look at this, and I immediately went on vacation. So
Right,
I feel like I'm getting caught up still.
You're eating your coffee grounds and drinking Mountain Dew.
Yeah, in the basement, just trying to get caught up. But this is something where talk to your planners, talk to your accountant, really kind of figure out, okay, what can I take out of this? Because a lot of stuff is a sprint. A lot of these things are short term. So you got to really figure out, okay, what can I take advantage of the next few years? There's some planning things here. Like if you're a retiree and you're 65, you're listening to this, you got an extra $6,000. Like maybe you do more Roth conversions for the next couple of years to make up that difference and be a little more tax efficient now. So there's some things you could really kind of think about how to strategize from a planning standpoint that you could leverage this bill for.
Yeah. And I think, again, if you have complicated taxes in any way and you've been self-filing for a while, it may behoove you to have a consultation with a CPA or tax preparer, maybe have them, review your taxes.
Yeah.
Even if you're going to file them on your own, there are tax preparers that will do that. You fill them all out. They just review. Because again, it is adding some layers of potentially beneficial complication, but complication.
Absolutely.
Nonetheless.
Absolutely.
So talk to I feel like this is the end result of every episode. You need to talk to your trusted professionals, well, it be your financial advisor, your tax preparer, your accountant, one of those, because you just don't, this is so big, you don't want to go into it blindly.
Yeah, you're going to miss something for sure.
Yeah, and you want to save your monies.
Yeah. All right, well, that's it for us, right?
All right. So thanks for tuning in to the first episode of season 3, and we've got some exciting stuff in store. So
we got a good lineup this year, I think. So it's going to be fun.
Awesome. All right. See you next time.